They make it mechanical. You buy here, you sell here. It doesn't work that way. What we're talking about in this video is about trading. We are talking about trading. The profile does not tell you to buy. It does not tell you to sell. It doesn't do any of that. It is very quiet. Okay? Now the database that forms it is dynamic because it changes throughout the day. But when you start hearing people tell you, well, you buy, the profiles like this, you buy down here, sell up here. It doesn't work that way. That's a very mechanical approach to it, and it's so much more than looking at a profile. We are talking about trading. They understand that trading is a game. People like to make it a science. It's not a science. It is an art, and there is an awful lot of gamesmanship that goes on. Other traders, hedge funds, people like this, they play games with the market. If you don't understand the potential for that game, it's going to be very difficult for you to participate in this thing. If you try and make it a science, it is going to be very frustrating to you. Too much analysis, it will be very difficult to trade successfully. No analysis, it will also be very difficult to trade successfully. It is a combination of having a holistic understanding as well as an analytic understanding. I used to run an institutional trading desk, and having run an institutional trading desk, you learned an awful lot about how big money trades. When big money comes into the market, they don't come into the market and buy all at once. If I get an order on an institutional trading desk, whether it's in futures or stocks, if I go and buy all of what I'm supposed to buy at one time, guess what? The chances that I'm going to give a customer the best fill of the day are pretty slim. If I give them the best fill for the day, I got really lucky. I would prefer to give them an average fill. If I give them an average fill, I'm never going to give them the best, right? But I'm never going to give them the worst. And what you really don't want to do running an institutional desk, you never want to deliver the worst fill of the day to an institutional client. You will never be forgotten, and you probably won't have that business going forward. So let's say they give me a couple of million shares to buy if it's stock. What am I going to do? Or in this case, let's say sell. They're going to give me some to sell. I'll sell some early so the market will break. I let the market settle. I sell some more. I let it settle. I sell some more. It's more like a wave-like process. And usually it's not just one institution. A lot of times you'll get a tone to a day, and that tone will continue throughout the day. This is the S&P's April 30th of this year. And as you can see, the high was made early. The high was made early, so there was aggressiveness from the opening bell, right? The market sold off, it balanced. It sold off again, it balanced, it sold off again. It was a wave-like action throughout the day. That's kind of a standard. Now, sometimes you'll get markets just go straight down. I mean, they don't do any balancing. That's probably long liquidation. That's probably fear. These type of markets, when you have big money selling, will normally look something like this, normally like a wave kind of action. We want to trade value, not price. We'll see the slide again. But think about any business. Price is an advertising mechanism. Time regulates all advertised opportunities. And volume measures the success or failure of all advertised opportunities. When you put time, price, and volume together, when you get the composite, you have value. Biggest insult I can look to say to someone is see somebody that's trading and say, "Oh, you trade price." I know. Well, how would you like to say, "Well, I trade an advertising mechanism"? Sounds pretty silly, right? But that's all price is. Price advertises an opportunity. Some opportunities are accepted, right? Some opportunities are rejected. Value is kind of the composite of all of them. If in fact a market goes exactly to last night's close, or exactly to the yesterday's high, or exactly to yesterday's low, or exactly halfway back in the morning, do you think that's the long time frame? Do you think they're the longest time frame? Do you even think they know what unchanged is and all? They don't know. Do you think it's the intermediate time frame? They could care less. They have no idea. A lot of these big firms, they don't even have bar charts in their shops. Now, when you start getting down, it goes exactly to unchanged, exactly to the day's opening, exactly to the high and the low. Who do you think's dominating the market? What time frame? Probably the day time frame trader, right? Okay. The characteristics and the behavior of the day time frame trader is substantially different than the behavior of the next longest time frame. The day time frame trader will probably, if that's who's dominating the market, and what you're trying to do very early, figure out who's dominating the market. The day time frame trader, they will buy yesterday's high, they'll sell yesterday's low. The long time frame or longer time frame, they could care less. So you start very quickly to understand who's dominating the market today, who's dominating the market starts to help you identify what your opportunities are.